Hi everybody, Michael Lamott from ChartYourTrade.com, and today we are going to talk about how to scale out of a position. So very briefly, scaling out of a position simply means that let's say you have 100 shares of a stock. You would sell your first lot at sell 50 shares, then sell 30 shares, and then sell your last 20 shares. So you could scale out of a position in many different ways. It doesn't have to be in thirds. It could be you could have two sells, but the main thing is that you're not selling everything all in one shot. You're selling it at different stages along the way. So the reason why I like to scale out of positions versus selling everything all at once is because, well, for a few things. The main thing is that it helps manage risk. And it helps manage both physical risk, so like your physical capital, as well as your mental capital. So well, what that means is that as a stock, how many times have we seen a stock run up a little bit now where we're sitting on a halfway decent gain and then all of a sudden it rolls over and our gains are gone? Yeah, that's a tough pill to swallow in the market, and it's one that we have to deal with as traders and investors all the time. So the way that I like to deal with that is when I have a multiple of the amount that I've risked, I'll begin taking something off the table. And what that does is it allows me to lock in a little bit of a gain. And so it's protecting what I've risked, the capital that I've risked, but it's also putting me in a good mindset that I've locked something and it's getting me in the mood to sell. And it's it's putting me in a position where if it continues to move higher, then well, thank goodness I didn't sell everything. And if it does roll over and become a loss, well then thank goodness I sold something. So scaling out of a position really does help us from both a physical capital as well as a mental capital gain. So let's talk about how to actually do this. So the first thing that we need to do when we are scaling out of position or is to know the amount that we've initially risked. We did a video on setting stop losses. We could go look at that, but basically, if let's say you've risked 5% on a stock, right? So you entered and your stop loss is 5% below where you entered. I would look to begin taking gains on that stock somewhere around the 2 to 3 times the amount that I've risked. So anywhere between 10 and 15%, I would start to look to lock down something in that position. Anywhere between 25 and 50% of my position, I would look to sell at that point, just to lock something down. Then the next time that I would look to begin scaling out of position would be at 4 to 5 times the amount that I've risked. And the way that I've come up with these numbers, I didn't just pull them out of a hat. I looked at my trading journal and to see how my stocks performed and historically what my winning percentage has been, how much I've typically made on a winning trade. I've looked at the different stocks that I've traded and to see how they performed after I've sold. And so for me, selling somewhere between 2 and 3 times the amount that I've risked has worked, and then holding on to the rest, selling at about 4 to 5 times, and then what I'll do for the last part is just let it run for as long as it can until I get an actual sell signal. Then I'll sell that other part. So some kind of a defensive sell signal, and we'll do a whole nother video about defensive sell signals. So one consideration that we really do need to take into account for scaling out of position is the amount of transaction fees that we're going to incur. And it's important to think about that because I feel as though the transaction fees are really a secondary thought. But when, let's say we're working with a smaller account. Let's say we're working with, say, a $10,000 account, right? Or a $20,000 account even. And we typically have 100 selling transactions in a year, and we have E-Trade, right? So that would cost $700 for those transactions. 7 times 100, $700. So let's say we now want to scale out of a position, and we sell in 3 stages now. Now all of a sudden, instead of having $700 in transaction fees, we're looking at 300 sells or $2,100 in transaction fees. That's quite a hefty jump. So we do want to be mindful of that, and that's one of the reasons why I like these 2 brokers, Interactive Brokers. They are super cheap. They charge only $1.99 a trade. You need to have a $10,000 minimum account balance, but I also really like Robinhood. Robinhood charges 0 transaction fees. You can look up on the website how they actually do make money. They're not a scam. I've had a good size account with them now for about a year and a half, so they're definitely worth checking out. Anyway, let's take a look at an example of how this actually works. Okay, so let's take a look at a stock where this worked out extremely well, a recent trade. Let's look at Applied Optoelectronics. The ticker symbol is AAOI. There's another video that I did that you might want to check out as well about how we sold this one. But let's take a look at it from a scaling out perspective. So here we highlighted one of the entries that we took on Applied Optoelectronics. It had consolidated, it formed this downward trend line, and it formed a smaller consolidation within this larger consolidation here, and then it formed this little micro consolidation right around the 50-day moving average. So the advanced entry point was right here over at 63.85, and that's where we entered on that one. So we entered at 63.85, and our stop loss was set down here at 57.90, 10 cents below the low of this day here. So that gave us a risk of 9.32%, so definitely in the upper edge of the risk that I'm personally willing to take. Typically, most of my trades are around, I'm risking around 5%, so to take on 9.32% is quite a lot for me. The upper limit for me is 10, but the reason why I would even consider a trade like this is because AAOI at the time was a very high momentum growth stock. So I knew that it could take off and have a gigantic run. I didn't know that it would run like this at the time, but I knew that this stock was capable of these kinds of moves. So I took that trade. So with an entry of 63.85 and a stop loss at 57.90, we're risking 9.32%, or risking $5.95 a share. So going back to how we would scale out of this position at between the first time that we would scale out is around 2 to 3 times the amount that we've risked, and then again at about 4 to 5 times the amount that we've risked, and then finally getting out when we have some kind of a sell signal. So the first time that we hit between 2 to 3R is just a couple of days later, on July 13th. AAOI closes the day at 78.04, so we're getting out on this day at about maybe about 2.5R. And I generally like to wait until the end of the day to take my exits. Part of this is because just because I'm still somebody that has a full-time job, and I can't sit and look at the market all day long. So I like to check in on my stocks at the end of the trading day, and it also gives us a full trading range to look at. So two things right there for why I like to do it this way. So then, as the trade progresses, again, just a couple of days later, we're hitting that 4 to 5R mark, right? So on July 18th, AAOI closes the day at 90.18. So sandwiched right in between that 4 to 5R range. So roughly 4.5R locked in there. And then on the last part of the position, I think I was holding somewhere between 30 to 40% of the position at this point, and we were writing it up, and then it was getting ready to report earnings, and I started to think to myself, who else is there really left to buy the stock, and what's my downside if it craters, right? So you always have to think about things like that, especially around earnings releases. And I looked to see where major support was, and major support was really nowhere in sight. I mean, like, if we look at this run, it never really developed any additional support levels, and so the next support level would maybe be this former high over here at around 75. That would put it close to the 50-day moving average at the time. Okay, so that would mean that I would have to suffer a drop of about 24-25%, and that's it opened slightly slightly below the 50-day moving average. It ultimately dropped. Well, look at that. That's ridiculous. A 34% drop right after earnings, and to have to even be concerned about a 25% drop after earnings for potential upside of maybe 110, 115, on only part of a position, to have to end up risking basically my entire gain so far, just not worth it. And that's why I ended up selling on that day right before earnings were released, and thankfully got out maybe about 2 minutes before the close. So that's how we scaled out of AAOI. Let's take a look at another one, because it's not always as clean and as large of a move as we saw here. So here's a stock that wasn't as easy of a trade. Talking about MOMO, ticker symbol MOMO. And so we can see here that it's set up in a cup-shaped base. It broke above this advanced entry point from within that base, and I took an entry at 42.05, and I set my stop loss at 39.90. That was just below this short-term support level. I was comfortable with that because it correlated to a former high that was then acting as support. It was tested multiple times, and it also had the 10-day moving average coming up and supporting that level. So multiple areas acting as support. Always like to see that for support levels. But anyway, this is a video about scaling out, so let's talk about that. So my first sell ended up being on this day over here, July 27th, and the high of the day was 45.59, and it closed at 43.19. So why did I sell? There was actually just a sell signal on that day where we saw this kind of a move. It was an expectation breaker, and that's more of a soft sell signal, like an expectation breaker. Well, what does that mean? It's one of those things that you gain with experience, where you would kind of like see a stock moving and it should behave in a certain way, and when it doesn't, I've found in my own trading that it's often a lot better to take some kind of defensive action when there is an expectation breaker like that. Just again to help preserve both the physical capital in case if something does roll over, and based on experience, I've seen things collapse when you have moves like that, but also to help preserve that mental capital as well. So I ended up taking something off the table on that day. Held through the rest of it, ended up selling a bit more when it finally did hit 2 times the amount that I've risked on this day on August 8th. The high of the day was 46.69, and it closed at 45.80, so I was getting roughly 2 times the amount that I've risked on that day. And then what I noticed, and you the only way to see these things are if you are paying attention to your stocks every day, and it doesn't take that long to just looking at the charts towards the end of the day and then seeing what you pick up. I noticed this short-term trend line, this short-term upward sloping trend line, and it was getting support along that, and so I thought that, okay, Momo is acting a little wonky at this point. I'm going to move my stop loss up to this low here. It was right around 43.90. If it breaks below that, then I'm not going to sit and wait for it to pull all the way back to the 50-day moving average. And it was a good thing that I did sell on that day, because just a couple of days later it dropped down to 40.05, still above my original stop loss. But when I make 2 times the amount that I've risked and I start to take off based on that, I move my stop, my base stop up to break even. So all of my shares are going to be sold at least at break even, so that way I'm not taking a loss. And it would have fell right through that. So I ended up saving myself a little bit there. And then just a week or so later, Momo, after reporting earnings, just cratered, similar to what we saw in AAOI. And that's something else about earnings too. We always have to be mindful of, okay, where is support and what's the worst case scenario that can happen to our stocks if they blow up. So this is not something that I would have held through earnings either. It's not a decision that I had to make, but this is a good example of how scaling out of a position helped me lock in gains before an ultimate collapse as well. So that is how we go about scaling out of a position. Again, number one, we need to know how much we're risking on the position. That way we know what our 1R, 2R, 3R, etc. targets are going to be. Next is to sell off a piece of the trade when we get to between 2 to 3 times the amount that we've risked. Generally, I take off anywhere between as much as 50% to as low as 25% when I hit 2 to 3R. Then I'll generally wait until I get to 4 to 5 times the amount that I've risked, and then take off a little bit more there. And generally on the last bit that I'm holding, I will have anywhere between as much as 40% of the trade to as little as about 20 to even sometimes 15% of what I was holding. And that part I'll just let run until there's some kind of a sell signal or reason to exit the trade. And that's how we scale out of a position. Thank you so much for watching. I truly hope that you got a lot out of this video. If you did, leave a comment in the section below. Let us know what you thought of it. If you have questions, leave your questions in the comment section below too, and I will personally answer them. Also, take a moment, like the video, and make sure that you subscribe to our channel so that way you get all of our videos in the future. Thanks again for watching, and I will see you again real soon.